All right, forget what you've heard from the usual crypto gurus. Today, we're diving into a pretty bold Bitcoin prediction, and it's from a source you might not expect. Eric Trump? Yep, he's making a serious case for $1 million Bitcoin. And in this explainer, we're going to break down his entire argument piece by piece. So the whole thing really boils down to this one huge question. It kind of flips the script on the whole crypto debate. Is $1 million Bitcoin not just some wild fantasy, but maybe, just maybe, becoming inevitable? Look, it's a massive claim, so let's dig into the logic he's using to back it up. And he is not shy about it. This isn't some off-the-cuff comment. He says, I really do believe that you're going to have $1 million Bitcoin. He sees this as a deep conviction, and it's built on what he calls two major structural shifts that are happening right now. So let's jump into that first big idea. Okay, so here's the first pillar of his argument. And it has nothing to do with hype or meme coins or any of that. Nope, it's all about something much more fundamental: infrastructure and access. We're talking about the floodgates of traditional money finally being opened up to Bitcoin. The whole thing really starts with this one simple idea: access. Think about it. For the very first time, the biggest, stodgiest, most stable pools of money in the entire world are getting a direct, easy on-ramp into digital assets. And we're not talking about day traders here. We're talking about the kind of capital that gets invested and then just sits there for decades. And to give you a sense of the scale we're dealing with, just look at this number: 40%. According to the source, a single player like Fidelity controls something like 40% of the entire 401k market. I mean, that is just a colossal untapped ocean of long-term money that, until now, couldn't really touch Bitcoin easily. Right, and here's why that's so important. This isn't speculative, hot money that's going to jump in and out of the market. No way. This is passive, recurring investment. It's money that flows in automatically every 2 weeks with every single paycheck. That's the kind of capital that doesn't just create temporary price spikes, it builds a whole new price floor for an asset. And he uses this really powerful analogy to drive the point home. He says, the dam is breaking. We're only on the 1 yard line with 99 yards left to go. So in his mind, all this recent news about Bitcoin ETFs and 401k access, that's not the main event. That's just the kickoff. The real game hasn't even started yet. And this is the feedback loop he sees playing out. It's like a domino effect. First, you have the big US institutions offering access through things like 401ks and ETFs. Step 2, that steady retirement money starts flowing in. Then, because the US is such a financial heavyweight, the rest of the world starts to take notice. Global regulators begin to follow suit, which then makes it easier for everyone else to get involved. And boom, adoption just keeps accelerating. It's a cycle that feeds itself. But that's only half the story. His thesis isn't just about money being pulled into Bitcoin because of these new on-ramps. He argues that people are also being actively pushed out of the traditional financial system. And for him, well, this part of the story got very, very personal. Yeah, this is where the whole thing stops being just about numbers and charts. He talks about his own family's experience with what he calls debanking and how it was a massive wake-up call. He said how corrupted centralized finance could be. It took one person to be able to effectively cancel us from modern finance. Just imagine that. The realization that one person, one decision could just unplug you from the entire system. And so that experience really highlights the two different worlds he's talking about. On one side, you have the system we all know, centralized finance. He sees it as slow, inefficient, and permissioned, which is just a fancy way of saying you need someone's approval to do anything. But on the other side, you have this decentralized world, which is built to be the opposite. It's fast, transparent, and permissionless. The rules are just code, and they apply to everyone, no exceptions. You know, his conviction really clicked into place when he realized this wasn't just happening to his family. He started seeing stories about regular people, everyday crypto users, just getting letters saying, sorry, your account is closed. No real explanation, no way to appeal. And that's when it hit him that this debanking thing wasn't just a one-off, it was a systemic risk. It showed how the financial system could be used as a weapon. And if that's happening here, you can only imagine how much worse it is in countries with really unstable governments. Okay, so you've got these two massive forces, right? On one hand, mass access being built from the top down. On the other, this growing distrust bubbling up from the bottom up. So what happens when those two things collide? Well, according to this thesis, you get the perfect storm for a truly historic repricing of Bitcoin. So the big idea here is that it's not any single thing driving this. It's everything happening at once. You've got mass access through retirement accounts.
You've got institutional custody, which was a huge problem, now basically solved. You have the wild success of the spot Bitcoin ETFs. You throw in that growing distrust from debanking, the fact that global money supplies are expanding, and oh yeah, there's a fully working decentralized alternative just sitting there ready to go. It's that potent mix, that perfect storm, that he believes changes the whole game.
And this is really important to get. While you hear these huge headline-grabbing numbers like $200,000 or even $1 million, the real thesis isn't about predicting a specific price on a specific date. You got to see those numbers as more of an expression of scale. They're a way of trying to describe a fundamental, once-in-a-generation reevaluation of an asset. And that's really what this whole argument boils down to at the end of the day. It's not really about trying to predict a price. It's about asking a totally different question. The whole debate gets flipped on its head. It suggests that maybe, just maybe, the conversation shouldn't be about whether Bitcoin is risky to own. Maybe the real question is, in a world like this, is staying 100% in the old legacy systems the bigger risk? Something to think about.